Tom, I think you're on mute.
Thank you so much, Robert. What a rookie error. My apologies, everyone. Good morning. This is Autovista Group's Residual Value Outlook webinar, Regional Shifts and Trends. I'm Tom Geggus, editor of Autovista 24, and I'm going to be your moderator today. I'd like to invite the panel to introduce themselves, and please don't make my rookie error and leave yourself on mute. But Anna, I will start with you. If you could tell us a bit about yourself and what you'll be presenting today.
Yeah, sure. I'm Ana Azofra. I'm Regional Head of Valuation and Insights for South and West Europe. And today I will focus on the impact of the global environment on residual values and our outlook for 2026, expected trends by powertrain, and also at what makes a model a top residual value performer.
Robert, if we can come with you next.
Thank you for having me. I'm Robert Madas. I'm Regional Head of Valuations for the DACH and CEE region. And I'm looking forward to present some of the macroeconomic trends we see today, how it affects the automotive industry, and also to dig a bit deeper into the differences between CEE and Western Europe when it comes to those macroeconomic factors.
Wonderful. And last but by no means least, I'll come to you, Ulmis.
Good morning, all. I'm Ulmis Horchidan, Cluster Head of Valuation for Central and Eastern Europe. And today we will look into market-specific and developments for the CEE region.
Wonderful, wonderful. Well, there you have a small outline of what to expect for today, but I'll give you a little bit more detail. So first of all, yes, we're going to provide a view on the current macroeconomic environment and how this is impacting the used car markets in Europe. We'll then analyse 2025's residual value trends with an outlook to 2026. And in the third segment of today's webinar, we're going to take a special look into Eastern Europe and what's happening with residual values there. Now, all of this is going to be topped off by a question and answer session at the very end of the webinar. And you can begin asking questions right now if you'd like. All you need to do is go to the toggle page on the menu on the top right hand side, and you shall find a box there to start putting in your questions. We'll try and get through as many as we possibly can with the time we have at the end of the end of the webinar. But if we aren't able to get to you, we will of course reach out to you after we're done today. So one way or another, you will get an answer to your question. And last but no means least, you will see that there's also a QR code on some of our slides today, which will take you through to autovista.com/explore, which is just packed with any additional information you could possibly want. Now, I think that's enough intro. Let's get into the meat of today's webinar. Robert, what macroeconomic factors are currently defining Europe's used car markets?
So if you look at the latest OECD outlook from January, let's look on the left-hand side first on the growth projection. So there was growth worldwide, GDP growth around 3.3% in 25. It was quite resilient, but now there is projected a decrease in the next year, in 26, in this year, to 2.9% on a global scale. But in 27, again, growth is projected to pick up a bit. So near-term activity is expected to be a bit weaker because of higher tariffs and also slowing investments and trade worldwide. If we look into this regional split that you can see on the left-hand side, we can see that the Asian economies, mainly China, are the key contributors to global growth, higher than in the US or in the Euro area. But also the Euro area economy is proving quite resilient, even a bit better than expected in the beginning of 25, according to the European Central Bank. We already see some household incomes rise on average, government spending increases, and also improving financing conditions. So there is also for the Euro area expected slight growth in the year 27. If we look at the right-hand side of the slide, this shows us what defines demand, mainly the inflation rates on the top and consumer price index in points on the bottom. Inflation rates in Europe are coming down slowly from a quite high level, but it's still higher than pre-pandemic levels. So there is still some effect on demand. But the headline inflation is projected to decrease further in 26, around 1.9%, and even further in 27 to around 1.8%. This means that the consumer price index, showing us what households have to spend compared to previous years, will have a bit of a easier time after the all-time high in October 25, where the consumer price index has shown like a really high level. So now the affordability of goods should start to improve again. So summarized, the outlook is still tense, with a somewhat positive view, especially on the demand side. However, I would like to note that this outlook from the OECD was released before the latest tensions around Greenland and the escalation and also the new US tariffs that were announced with regards to this.
So then in relation to the automotive industry, Robert, what are the effects?
There's in 26 still uncertainty. So we can summarize it, as you can see in the headline, that the economic and geopolitical situation still keeps automotive under pressure. On the one hand, we have market demand that is with some respect improving a bit. So if you look at new car registrations, we had a slight increase compared to 24 of approximately 1.5% overall. So the steep declines of post-COVID years are over, but it's not like a real spectacular recovery. Also, used car demand has stabilized somewhat. There were no significant swings or downswings in this year, and the same is expected for the next year. So this is a somewhat positive note. On the other hand, geopolitical risks are still there. So we've had tariff tensions with China. Even there has been some de-escalation due to negotiations, but still there are new tensions and announced tariffs. So there is another risk for trade war or for trade conflict escalation. So even if there was managed de-escalation, is still uncertainty affecting the automotive industry. Then if you look at regulatory developments, there have been some flexibility introduced. So the 2035 zero emission target has been made a bit more flexible. Instead of an outright ban of ICE vehicles, the plan is to have a 90% reduction target. But still, this means there is a lot of incentivizing and different incentive schemes for electric vehicles, meaning a volume push to the markets. Again, meaning then for used car markets that the volumes that will reach the used car markets in the next 3 to 5 years might be higher than demand can really absorb them. Talking about EV market and the electrification of fleets, this is still in progress. There have been some significant technological advancements in the latest years. The BEV share has risen, mainly driven by Western European markets, as we will hear also later today. But there is also more competition coming in, more competitive pressure, primarily from Chinese EV manufacturers. And there is generally a profitability issue still due to high R&D investments necessary in the EV market. I've already mentioned profitability, so that's the last point on this slide. OEMs have still have to fight against rising costs. There is a different regulatory compliance coming from regulators, aggressive pricing from competition from outside of Europe, what I've mentioned before. Still the need for high R&D investments. Also, the supply chains face new ESG-driven challenges, like, for example, the battery passport compliance regulation, also the regionalized productions requirements, all this meaning additional costs for OEMs. So there is pressure, and this pressure can be felt on the automotive markets as well on the new car side, but also some of it transfer to the used car side, as I've explained.
Thank you, Robert. Anna, I think it's time we dig a little bit deeper into the used car market. How are all of these factors influencing used car prices?
Yeah, sure. All these factors that Robert has been referring to, the weakening demand, high inflation, geopolitical tensions, conflicts, and even tariff wars point to a certain structural weakness in the automotive market in Europe. And this weakness has been, of course, reflected through the year in the evolution of the used car prices. In this chart, used car price index by market, extracted from our residual value intelligence tool, we can see the trend in asking prices across the 5 major European markets and its own evolution versus January 2025, which is the value we use as an index. And it's true that the first half of the year was relatively stable, and in some countries, such as the UK, which is the red line, and Spain, the yellow one, residual values even show some improvement. However, in the second half, and especially in the last quarter, negative adjustments intensified significantly. Among all markets, Spain has shown the greatest resilience for the reasons we have mentioned several times over the year in our previous webinars, reports, and specific podcasts as well. The Spanish economy is currently in a solid position. Inflation is lower than in many Eurozone markets, and demand remains strong. That said, the accumulation of stock in young used cars has also had an impact in the last 2 months, as we can see in the chart. Stock accumulation is one of the key performance indicators, as Robert will explain in a few minutes. Overall, the pattern we see in these 5 major markets is very similar to what we observe across the rest of Europe. And one might think that Italy, which is the green line, represents the most extreme case, but that is not necessarily true. Many smaller countries, such as Finland, Sweden, Belgium, or Switzerland, are highly exposed to economic stress and the impact of all these factors. And in the end, the smaller markets tend to be far more sensitive to economic tensions. And if we move to the next slide, there is one market, Poland, where the decline has been particularly sharp, as shown in this chart. Poland is represented by the gold or brown line. Poland is the leading market in Eastern Europe and plays a key role in the remarketing flows of the major Central European markets. And this is one of the reasons why we wanted to place a special focus on Eastern Europe markets in this webinar. And my colleague, Ulmis Horchidan, will walk us through this in more detail later.
Well, thank you so much, Anna. I think that actually brings us to the end of our very first section. So thank you all very much for your insights so far. Now, we have already had some really great questions come in, so please do keep them coming for the Q&A section at the end of the webinar today. And additionally, if you need more information about anything that you hear in terms of any products you might see, please do feel free to scan the QR code there on the screen. So it's time for our second segment, the 2026 Residual Value Outlook. Now, before we do get straight into that, Robert, maybe you could tell us what's happened with residual values over the last 12 months.
Yeah, as shown by Anna before, where we have seen the used car price index from our weekly market observations, here we can see the residual values that were published by Autovista in the big 5 markets and Austria and Switzerland. And not surprisingly, this follows, of course, what we observe on the market quite directly. And we can still see that in 25 markets have seen values fall, but at a slower pace if we compare it to the year 2024. Only in France and the UK, UK is the red line, France is the blue line on the chart, we can observe a slight increase in Q4 25. But a part of this, RVs have been under slight pressure in the year 25. They are still under the levels of 24 and 23, so the post-COVID years where we had these high levels and this boost in RV values. But overall, this can still be described as a continuous market normalization. there are volumes on the new car market increasing after the supply crisis, and also these volumes are coming to the used car markets in higher numbers year by year. So that's the effect that can be seen on the RV trends here.
So that's in percentage RV changes, Robert. What have other market KPIs revealed?
When looking at market indicators, it's especially interesting to look at the recent trends for stock days and also on the number of price changes and the value of price changes that dealers apply to their stock. So in this example, we look at used car adverts in Austria from January 25 to January 26. So really recent data here of 2 to 4 year old vehicles. On the top of the chart, we can see the stock day evolution. Stock days usually indicate market saturation, and we can see a slight increase in the last 3 months on the right-hand side of the chart. And this affects actually all fuel types, with BEVs still being the fuel type selling slowest, followed by PHEV and then the internal combustion engines. That's quite typical in most European countries to see this ranking and this pattern in stock days. On the bottom of the chart, we can see price changes development. In this case, we display the price change value in percent. This indicates the desirability of vehicles and indicates how much price management is needed by dealers to create the turnover of the stock. And we can see that EVs, specifically BEVs, need more price management, and that also the values have increased a bit in the last 3 to 4 months. Meaning that all fuel types need a bit of more discounting compared to the original asking price that can be observed in the portals to really create demand. So those indicators can indicate that this age group can expect some slight more pressure in the coming months based on our analysis.
Thank you very much, Robert. Well, Anna, I think it's the moment of truth. What is going to happen with residual values in 2026?
Yeah, well, forecasts remain stable and on a path of toward normalization, as Robert has mentioned, because the most significant adjustments have already taken place over the past 2 years. This is the good news. On this slide, we can see on the left the current map as of January 26, showing average residual values across these 7 markets. As usual, 36 months and 60,000 kilometers, as we use in our webinars. On the right-hand side of the map, we saw the expected adjustment for December 26 compared to the current value. And as you can see, all countries keep their outlook for this year in line with previous expectations. Might overall adjustments with differences by powertrain. Spain is the only market improving its outlook, as we mentioned before, reflecting its stronger resilience in 2025. And we could say that Spain, France, Austria, and the UK are expecting only very mild value adjustments by the end of this year, all below 1%. While Germany and also Switzerland saw a slightly more negative adjustments as demand is weakening, stock levels are increasing, and days to sell continue to increase, as Robert just highlighted. And the most dramatic case, which is very visual, Italy, which experienced a sharp drop last year, and it is still expected to record the steepest decline among all the markets analyzed, more than 5%. And no clear market stabilization is expected in Italy until 2028. Overall, and in summary, overall outlook remains negative across all powertrains and age bands, especially for 3-year-old vehicles, where stock accumulation is strongest and days to sell are in fact increasing.
Thanks, Anna. You mentioned powertrains there, and of course, these are all market-wide averages we're talking about, but are all powertrains experiencing the same trends?
Mhm. Yeah, actually, the differences are significant and will remain so through the coming year. The main concerns, the most frequent questions we receive are related to BEV residual values. However, this chart shows that the sharpest RV declines have not occurred in electric vehicles, which is the dark green bar, as most of the BEV corrections already took place in 2024. And this chart shows the decline measured in percentage points by powertrain type across three major European markets. And it's true that we are talking about residual value values in percentage terms, which can translate very differently in absolute terms. At the bottom in the circle, we saw the average drop across all powertrains, while the bars represent the decline for each engine type over the last 12 months. In general, the three countries, in all of them, larger drops have been recorded in hybrid powertrains, both full hybrids and plug-in hybrids. And when it comes to full hybrids, there is a common factor across the three countries that helps explain this performance. The hybrid mix between the used car supply. We are seeing an extension of hybrid availability, both through new entrants offering hybrids and also through traditional brands expanding their hybrid portfolio. And these vehicles tend to deliver weaker residual values, impacting average residual value in a negative way. On top of this, in Germany, we also see that we have mentioned this many times before. The hybrid powertrains simply do not resonate with buyers in this market. All these trends will remain this year, with the exception of PHEVs in France and to a lesser extent PHEVs in Italy, which suffered a significant drop in 2025. And in France is because during some time the PHEVs benefit from some tax incentives, which made them attractive to corporate buyers, but later lead to market saturation in the used car channel. And usually often with first generation electric ranges and little real added value for used car buyers. And these tax advantages have now disappeared. Then we expect gradually to rebalance from 2026 onwards.
Hmm. So then, which segments, powertrains, models are still performing well?
Mm-hmm. Yeah, I think perhaps the best way to explain which factors really drive strong residual values is to look back at our residual value awards and identify the common elements shared by the winners in each segment. So on the right side of the table. These results were published last October and reflect the residual value winners across 17 countries in Europe. For those who may not be familiar with them, this information is still available on Autovista 24. And it may also be useful to start with a question, which you can see on the slide. Do all new car market dynamics translate directly into the used car market? The answer is probably not. There may be some similarities in purchase motivations, but not when it comes to the factors that truly determine a strong residual value performance. In the used car market, the buying motivations tend to be more deeply rooted, more conservative, or more traditional, if you allow me this expression. And if we look at the full list of winners, we found Mini, BMW, Audi, Mercedes, then a clear pattern emerges. German premium brands dominate. And this highlights the importance of manufacturer origin. But it's not just about origin itself, it's also about the attributes associated with it, such as a strong perception of durability, typically conservative design, which ages particularly well over time. At the same time, we also see the value of the distinctive or iconic design as G-Class and of course Mini, which is a winner across all powertrains and segments and had already topped the rankings in 2024. Additionally, one of the mantras we often repeat when talking about residual values is that high list prices tend to penalize residual values. And yet, in this list, we also find very expensive models such as Mercedes E-Class, G-Class, also, of course, Porsche Macan, clearly showing that it's always a combination of factors and that pricing is ultimately driven by brand equity. And brand equity is not exclusive to premium brands, as all these models coexist with a very different proposition like the Dacia Duster, which stands out for its refined value proposition and strong value for money positioning, once again securing a place on the podium.
Amazing. Thank you so much, Anna. Well, that actually finishes off our second segment for today. Next up, we'll be taking a deep dive into Eastern Europe and the residual value trends there, followed, of course, by our Q&A section at the end of today's webinar. So please keep on submitting your questions. I can already see some excellent ones here. So we have been talking about Europe quite generally here, but let's focus in on Eastern Europe. What macroeconomic trends are apparent in the region? How does this compare to Western Europe, Robert?
On this slide that you can see here, we compare the GDP per capita in selected CE countries with the EU average. The EU average is the 100% line or 100 index line. And you can see the evolution in the last 12 years in the different CE countries against the EU average. And as we can see, most CE economies have been growing faster than Western Europe in the last years, driven by EU integration, by foreign direct investments, by supply chain participation, especially in the automobile industry, but also in machinery and others, also rising real wages. So the GDP keeps improving. However, against the average GDP in Europe, the GDP per capita is still behind the EU 27. And depending on the country, this can be quite significant, as we can see, for example, for Bulgaria on this graph, and also for some other countries to some extent. So there is a persistent productivity gap, lower capital intensity, lower R&D investments, and also we must not forget there is also demographic challenges in some countries where the population is aging, where there is emigration of workforce to Western European markets. And in the last year, also the energy price shock hasn't helped for a quicker growth here. But the outlook is positive. It is expected that CE countries will continue to outpace the euro area in terms of growth. The European Central Bank expects for the EU around 1.2 to 1.4% growth, similar to the OECD that I have shown before. While regionally in CE region, there is an average of 2.5 to 2.8% growth expected. So there will be another, let's say, catch up, even if the catch-up will be slower than in the years around 2000. So we can talk about moderate growth rather than a spectacular growth. But still, also CE countries, of course, are exposed to the trade and geopolitical risks that we have discussed in the beginning of the webinar.
Makes sense. Thank you, Robert. So how have all of these factors driven RV trends in different Eastern European regions and markets? Ulmis?
we see different behavior when we analyze each country from the CE region. For example, Poland had ample room for adjustments coming from the high values in 2022 caused by the supply crisis. Also, Hungary and Slovakia recorded a steeper depreciation in the last 2 years, while Romania and the Czech Republic recovered quite fast after the peak in the pandemic, once supply started to catch up with demand. As you can see from the chart, for now, all of them have settled in a predictable and stable pattern.
So then, what's happening with residual value retention across the different powertrains in the region?
Well, looking in depth at the biggest market from the CE region, which is arguably Poland, we see strong RV retention for powertrain, which historically had a big market share, and to this day remain extremely popular, like diesel and petrol, while BEVs and also PHEVs suffer from accelerated depreciation. It must be noted also that for BEVs and PHEVs, the same pattern of steep depreciation applies for all countries in the CE region. Also, only the percentages are market specific. One of the main reasons for this is a lack of public charging infrastructure, often coupled with questions regarding real-life driving range and charging times.
So then, can you take us through what you're expecting to happen to residual values this year?
The market outlook for 2026 still trends slightly downward for all countries from Central and Eastern Europe. So looking at 36-month-old vehicles, we expect their value to sit slightly lower in December 2026. As you can see across CE, the decline is softening, the markets tend to stabilize. So we predict low impact in Poland and Hungary, and somehow a moderate impact for the other countries from the CE region. To note, please, the graph is expressed in percent, not percent points.
Then, with these things considered, Ulmis, what would you say are currently the key risks in Eastern Europe when it comes to used car markets?
So first and foremost, we are witnessing an influx of Chinese makes. And as behavior in general, they tend to squeeze the market by taking from the pool of existing customers, not exactly creating new ones, at least for the moment. Then we have the growing new prices. We expect the new prices to continue their upward march because new standards like EU7 introduction coupled with hybridization to be also partially responsible for this behavior and to incur costs. At the same time, to counterbalance this, at least in CE, OEMs will adapt by offering discounts and other special offers. Another risk is a lack of young used vehicles, which will create an imbalance between demand and offer and alter transaction prices further. Regarding hurdles for electrification, so electrification in its most advanced form, I'm talking here about BEVs and PHEVs, I won't include here mild and full hybrids, come with a big price tag which has a direct impact on new car sale as well as residual values, especially in this part of Europe where the market has a lower purchasing power compared to the EU average, as Robert already mentioned. Government incentives were key in order to boost new car sales, coupled with other benefits like exemptions from registration, road tax, free parking, and so on.
So then maybe you could walk us through some of the opportunities as well.
So another point is the exchange rate. It's another threat for non-euro currency countries, and basically in the past, Hungary and Poland were affected by this variable, with the price hike being transferred to the buyer, while at the same time impacting new car sales volumes. Mm-hmm. Regarding opportunities, so as you can see from the graph in the left, there is a growing need for personal mobility in this region. So for some countries in CE, namely Romania, Hungary, Slovakia, Croatia, there is still ample room for growth. And as a side note, many times this need is covered by importing used vehicles sourced mainly from Germany. The influx of new brands of Chinese manufacturers in the last years carried with them a huge range of offerings, from affordable models going through high-tech ones like BEVs and all the way to premium-like models. They offer unique selling points like 7-year bumper-to-bumper warranty, and they do this with very attractive pricing. And I will also mention that in the majority of cases, the new OEMs entering the market are managed by experienced local teams with a very good grasp of the market dynamics. Another strong point and an opportunity for the CE region is becoming a central hub for automotive production. It is growing in terms of supply chains with localized RDT&E, so research, development, testing, and evaluation, as well as manufacturing. Some European makes started to switch production from Western Europe to the CE region, while a Chinese OEM built a factory from the ground up in the region. Thanks to this holistic approach, CE production covers hybrids, PHEVs, as well as BEVs.
Thank you so much, Ulmis. That does bring us to the end of our webinar today, but not the final, because we do have one last section, which is the Q&A section. Thank you all so much for submitting so many excellent questions so far. Now, again, if we can't answer your question during the session today, please don't worry, because we will reach out to you afterwards by email. Now, one thing that's definitely come up, Anna, not only by almost mentioning it earlier, but in questions, are Chinese brands, and there are many of them entering Europe. So how might this impact residual values?
Mm-hmm. Yeah, it's difficult to identify common patterns, as I would say that one of the defining characteristics of Chinese brands is their agility and adaptability, meaning that their performance can vary significantly from one country to another, and even from one model to another. And that said, in general, the early stages are always challenging. Residual values tend to be low at the beginning. The products can be highly competitive, but the brand awareness still needs to be built. And entering the private market is usually easier for them, and especially in case of reasonable pricing. But the fleet penetration is more complex. And then at the earlier stages, brands often find themselves in the same cycle. No? The product is competitive, but residual values are not yet strong. As a result, discounts are needed to gain access to fleets, but discounts penalize residual values, and sometimes it's difficult to find the balance, and it takes time. But yeah, I would say that sometimes some brands are not new entrants anymore and are already starting to compete at the same level as well-established brands in these markets.
Great answer. Thank you so much. Robert, I think given that you are our macroeconomics expert for this session, I think this topic kind of goes well to you, because anyone looking at the headlines currently would see the enormous amount of global tensions and kind of things going on in the world. How do evolving geopolitical tensions impact used car markets?
I think this depends on how the tensions will transfer into the actual measures, and if there will be like a real trade conflict or trade war coming up, because usually by those conflicts, new car markets are more affected and supply chains are more affected and imports are affected, because that's the target of those measures, and meaning that this could lead to higher prices then on new car markets, to less volumes on new car registrations, and then also to less volume on used car market in the future, which would then mean some stabilizing element on used car pricing. So it's quite hard to say today how this can really transfer to used car markets. It really depends on what measures are taken and how are they applied, and will it really have effect on what is happening on the new car market, as this is like the main supplier of the used car business in the coming years.
Thank you very much, Robert. Ulmis, let's just talk about imports in the CEE region for a second, because it's my understanding that they are pretty essential, really, no other way of saying it. Could you just talk us through how they direct the used car markets there?
So used car imports, Tom, are an uncontested reality in the CE region. In order to get an understanding about the used car imports, for example, in 2025 in Romania, for each new vehicle sold, more than 2 used cars were imported. For Hungary, this ratio is 1-to-1. So while the majority of imports tend to be older vehicle above 10 years, however, lately we see also younger ones, 36, 48 months old, entering the market and having a direct impact here.
Thank you. Thanks so much. Anna, we've had a few questions about the outlooks, and of course you were able to share what you're expecting for 2026. Could you tell us a bit about what's going to happen in 2027? Is there any way of looking forward that far?
Yes, of course. The 2027 outlook remains broadly in line with the current trends, but adjustments are expected to be very mild. And in all cases, they are projected to remain below 1%, with the exception of Italy that we have mentioned today. And even for 2027 is expected to record a decline of close to 5%. And for 2028, we expect similar trend, but even milder adjustments across all countries, along with market stabilization in Italy.
Wonderful, thank you. I think we could actually narrow in on a few of those markets, because obviously, Robert, you work on forecasts for markets like Germany, Austria, Switzerland. Could you take us on a bit more of an exploration of what's happening with RV trends in these countries?
One of the trends, if you look at Western European markets, shows that used car RVs, but also forecasts for BEVs, especially for younger BEVs, are improving. So we've been talking a lot about the deterioration of RVs for BEVs in the last webinars and last years, mainly for 36 and 48 months. But what we can see now, that in some cases, some newer models are even closing the gap to ICE models when it comes to forecast values, and also used car RVs for young vehicles that we can observe on the market. And this, I think, is due to the current portfolio on offer of more attractively priced BEVs, and also technologically more advanced BEVs compared to models that have been available, for example, 4 years ago. And I think this trend can be seen in most markets, at least in Western European markets already.
Wonderful. Thank you, Robert. Well, I think that is really all we have time for today. So thank you all for providing so many amazing insights. Now, while we're not able to provide the PowerPoint slide for this webinar, please don't worry, because you can find a full recording over at Autovista 24. And while you're there, you should also check out our next webinar, which is Europe's Auto Forecast 2026, Technology, Policy and EV Adoption. And that will be taking a look at Europe's new car market, and that will be taking place on the 1st of April. Now, if you've seen anything that you'd like to find out more about today, such as some of those price indicators and residual value trends, then please do go ahead and feel free to scan that QR code to find out more at Autovista Group, autovista.com/explore. Once again, a massive thank you to our wonderful panel for providing so many wonderful insights today. And the biggest thank you to the fantastic audience for showing up and providing so many excellent questions and support. So thank you all very much indeed. We cannot wait to see you at our next webinar. We'll see you soon.